Hi Ashish. Hi everyone. Thank you all for joining this webinar. And we really appreciate that you guys joined on time. But just to like include everyone, and we'll just wait for 2 more minutes and then we'll start. Hope that's okay.
Hello, everyone. Thank you for joining. I'm Yeeshu. I'm uh, I'm leading a UAE practice for AKM Global in Dubai. I'm based here. So just to give you an overview about the firm, so we are actually a 44-year-old firm, and we're headquartered in India. We have pan-India presence offices in multiple cities, and then even having international offices such as Dubai being one of them, in Singapore and in US. So we are a full service firm from business setup to tax advisory to compliances to complicated FIMA matters and then till liquidation. I'm very delighted to welcome all of you today to the webinar of Are You Ready to File Your First UAE Corporate Tax Return? Why is this session very crucial? Because as you all know, UAE is embarking on a major corporate tax season for most of the businesses having Jan to December calendar year as their first tax period. So their tax return is due by 30th September 2025. Anuj, can you please? So just to begin with, I would like to give a disclaimer here that our slides are purely for informational purposes, and please do not construe it as any advice or any consultancy with regards to corporate tax. If you would like to have a tax position or a tax clarity on a tax position or any tax advice, we advise you to, consult firms like us who can advise you basis the facts applicable in your case. Anuj, please move on to the next slide. So this is just about us. We are, like I said, we have a pan-India presence. We are present in UAE as well. Our clients are mostly multinational corporations. 95% of the clients are multinationals. We have around 650 employees, 650 plus employees rather, from all backgrounds, from accounting, audit, taxation, secretarial, legal, etc. We have a strong media presence. Our managing partner, Mr. Amit Maheshwari, myself, another tax partner, Mr. Sandeep Sehgal, other colleagues of mine heading respective divisions in the office are regularly quoted in the media. We are around 44-year-old firm. We were established in 1981. We are ranked consistently in International Tax Review as a leading tax and transfer pricing firm. So these are our rankings, and this is about our managing partner, Mr. Amit Maheshwari. He's some of the recognitions that he has received over the years. Anuj, next slide, please. So here we go. So what are we going to cover in today's session? We'll actually take you through the introduction of the corporate tax in the UAE, to on whom this corporate tax applies, who has to file this corporate tax return, by when do you have to file this corporate tax return, what are the filing deadlines, and what are these statutory deadlines apart from the corporate tax deadline, what are the documents that you must keep handy while preparing the corporate tax return or while filing your corporate tax return, elections that you will have to make. Some of the elections are irrevocable, or some of the elections you can only do make it in the first tax period. Free zone persons. So like a free zone person cannot get a 0% unless that free zone person is a qualifying free zone person. And for a qualifying free zone person, there are lots of checks and balances, there are lots of tick boxes that you have to check, and there are lots of things that you have to keep in mind before claiming that 0% benefit. Coming to the accounting schedules, which is another part of a tax return, an important part, will touch the aspects dealing with accounting schedules as well. Reliefs which are there under the law, other adjustments that you have to make. Coming to the tax liability ultimately, and if you have some credits which you can use to reduce your tax liability, we'll also deal with those. We'll also show you a corporate tax calculation template, a whole tax computation format at the end, followed by some FAQs. And then we will take Q&A at the end of the webinar. Anuj, please, next slide. So why corporate tax in the UAE? So UAE did not have tax historically. So his corporate tax came into effect from 1st of June 2023. So there is one thing which you'll have to, be very, keep in mind that it is in line, of course, meeting the economic goals for the UAE is a purpose to introduce taxation. By way of tax revenues, economic goals are met everywhere. But they also want to keep their systems in line with the international best practices. They do not want to be seen as a jurisdiction with no tax at all. Okay. And especially they are signatory to the BEPS 2.0 inclusive framework as well, which is popularly called as Pillar 2 proposals. So UAE has formally included Pillar 2 definitions under the domestic tax law already. They're yet to notify. Its formal application. However, domestic minimum top-up tax is already in force from 1st of January 2025. So that's related to pure Pillar 2. So we will touch the corporate tax return as it's a different subject matter. So tax rates in the UAE, only two corporate tax rates you have to keep in mind, 0% and 9%. 0%, of course, for qualifying free zone persons and the businesses having their taxable income less than 375,000 dirhams, which translates to 100,000 US dollars. For all the businesses other than qualifying free zone persons and their other entities having profits more than 375,000 dirhams is 9% tax on that. And MNEs that fall under the scope of Pillar 2 will gradually move to a global minimum tax of 15%. Here, the tax period is a Gregorian calendar year, which is Jan to December, which most of the businesses follow, or the 12 months period for which the taxable person prepares the financial statements. So it need not necessarily be Jan to December. It can be any period which has to be a 12 months period for which a business prepares its financial statements for. Of course, if somebody has to apply for a different tax period, so for an entity which is just newly incorporated and they just incorporated in, let's say, November, and November, December is only 2 months. And so they want to apply for a tax period of 14 months. So they can apply to the Federal Tax Authority in that case for a 14-month tax period, but only up to 18 months. Anuj, next slide, please. Taxable person. Why is this slide important is because corporate tax applies on taxable persons and all the taxable persons has to file the corporate tax return eventually. So it is broadly classified into three categories, which is a natural person, which is a juridical resident person, and a juridical non-resident person. Coming to a natural person, UAE does not have personal income tax at the moment, which means there is no tax on salary, there is no tax on personal investment income, rents, dividends, etc. However, if any natural person undertakes any business activity in the UAE for which license is required, because lots of freelancers are getting a freelance visa and they're doing their business activity here by consulting for some construction project, doing some architectural designing work or some interior designing assignments. Most of the freelancers do this way. Okay, so if their revenue from their business activity crosses 1 million dirhams in a year, then they have to register for corporate tax, they have to pay corporate tax, and they have to file corporate tax return as well. They have to register by 31st of March of the following Gregorian period. So, for example, Jan 24 to December 24 is the period in which a freelancer person having a license to undertake a business activity in the UAE has a revenue of more than 1 million dirhams. Then he or she has to register for corporate tax by 31st of March 2024 and has to eventually file corporate tax return by 30th September 2025. Similar threshold of 1 million dirhams is for a non-resident natural persons. However, the registration timeline is different for them, which is 3 months from the date of fulfilling of those conditions of crossing 1 million dirhams. They have to register. The tax filing deadline, everything remains same as it is in the case of a resident natural person. Coming to an important aspect of the companies here, because corporate tax, as the name suggests, primarily it applies to corporates. Okay. So juridical resident persons cover all the companies in the UAE, be it in free zone, be it in mainland, or anywhere in the UAE. So if they are incorporated prior to 1st of March 2024, let's say they are old companies doing business in the UAE, having a company since ages, like since 10 years, since 15 years, since even 40, 50 years. And there are clients who are in UAE since even 40, 45 years. We have those clients as well. So they have to register for corporate tax based on their trade license issuance date. Okay. It is in the cabinet decision number 3 of 2024, where there are timelines to register for corporate tax are mentioned. For the newly incorporated entities which were incorporated after 1st of March 2024. So for example, a startup company incorporated in the UAE after 1st of March 2024, then they have to register within 3 months. So for instance, a company is incorporated on 1st of April, then they have to register by 30th of June anyhow. Otherwise, the 10,000 dirhams of penalty will attract. However, that penalty is waived off if that startup company or if that company which failed to register for corporate tax on time is able to file its corporate tax return within 7 months of the tax period. So in this case, this startup had, let's say, suppose they got a penalty of 10,000 dirhams for not submitting corporate tax registration application on time. And then their their tax return filing due date is 30th of September. Since they follow Jan to December period, for hypothetically, they will have file their tax return by 31st of July 2025 in order to get this penalty waived off. For the non-resident persons, where all the foreign companies get covered, they have a simple rule which is dependent on the permanent establishment existence here. So permanent establishment, simply speaking, is a branch, is a classic example. Having a branch in the UAE is a PE of a foreign company. So let's say a UK based company or a US based company has a branch here, then that branch qualifies being a permanent establishment, and that UK company or a US company, as the case may be, has to register within a period of 9 months from the date of existence of PE if it was prior to 1st of March. So 1st of March is something as a cutoff date which you have to keep in mind whenever you're dealing with whether this entity has registered on corporate tax timely or not. And why is this? Why is it important? Because it has direct link to your penalty waiver, or in case of a late corporate tax registration, that you have to file the return within 7 months instead of 9 months. So by default, every business has to file the return within 9 months, but in cases of penalties that you want them to get waived off, you have to file those returns within 7 months. What is a tax base? So tax base is something that on which the government will collect tax, right? So for any business in the UAE, including a free zone company or a mainland, their worldwide income is taxed because they are residents here. For any foreign company which is effectively controlled and managed in the UAE, so all the people who are taking major strategic decisions, key decisions of the company are in the UAE, despite the fact the company is registered, let's say somewhere in England, that company will still be qualified as a resident if it is effectively controlled and managed in the UAE. A natural person who conducts a business activity, of course, he would be subject to tax on his worldwide income insofar as it relates to his business activities in the UAE. Okay. And for a non-resident, in case of a PE, the income attributable only to PE is subject to tax and not the worldwide income. And non-residents having a nexus in the UAE, only income attributable to the nexus. So nexus here is only linked to the immovable property and nothing else under the law. For non-residents deriving UAE sourced income, only the UAE source income is subject to tax, and the withholding right now is 0% on the UAE source income. Next slide, please. So a brief summary in the form of diagram of how this evolved, the entire tax law evolved, and how are we sitting right now and waiting for 30th September. The majority of the tax returns are going to be filed by then. So it all started in 2022 and 2022 when Ministry of Finance announced that they will be coming up with a UAE corporate tax law in the UAE. And then 1st June 2023, the CT law was effective in the UAE. November 11, 2024, they released the tax returns guide, and everything which is to be done with related to the tax return was mentioned over there. And right now it's May, and it's only 4 months, like I said, for the majority of the tax returns to be filed. Just an example on the right in the form of a table of a tax period and their deadline to file. Like I said, it is 9 months from the end of the tax period, which is the deadline of filing the tax return. So for a tax period of 1st July to 30th June, the deadline to file the corporate tax return was 31st of March 2025. Similarly, for tax periods in 1st of January to 31st December 2024, the deadline to file is 30th September 2025. Next slide, please. Some of the statutory deadlines, in addition to the deadlines to file the return, is a tax group registration. So tax grouping, as you might know, that there is a provision in the law where all the entities having a 95% of ownership or more can be grouped together. Of course, there are additional conditions as well, and they can form a single corporate tax group where the parent entity in the tax group would be responsible for filing the return. However, all these conditions, 95% or more ownership, and etc., have to be met throughout the tax period. So from 1st of January to 31st December tax period, all these conditions needs to be met every part of the day. It's not that these conditions were fulfilled for 6 months and the tax group can be formed. No. So the conditions have to be met throughout the year. CT returns is basically filing and tax payment. So there is no separate, filing. There is no separate deadline for tax payment as such. You have to pay it along with the corporate tax return. I'll show you at the end how to pay the tax accordingly, which, you have to filing the return. There'll be under the payment section. You'll have to pay the tax. Important thing in this slide is for liquidated companies. So I've got few, I've been into some of the discussions in the past where the company got liquidated in the middle of the tax period, and the position was taken that they were not required to register by someone. So let me be very clear, to tell you about this important thing, that even if the business, ceased to exist in the middle of the tax period, that doesn't absolve that company from the corporate tax registration and then filing the return and eventually deregister. So they have to do all of these compliances despite getting liquidated in the middle of the tax period. Next slide, please. Another important thing, what all documents are needed to proceed to file the tax return. One and first and the foremost is the financial statements. You should have financial statements in hand in order to proceed to file the tax return. And this list is only for the taxpayers which are not electing for small business relief. Small business relief I will cover later. It is a relief given to small businesses wherein you do not have to compute any taxable income. You do not have to go for other compliances, no audit, nothing. So that's a small business relief. You elect it and then you pay zero tax. Okay. Documentation to support the market value of the immovable property. This is for transitional rules. So entities having immovable property in their balance sheet, they have to they have to have the valuation done at the first on the first day of the tax period, so that they can take benefit of the transitional rules. Again, another part of the transitional rule is the documentation to support the market value of financial assets and financial liabilities at the start of the first tax period. So here, the start of the first tax period, you can assume it as 1st January 2024. Evidences of foreign tax credits paid in another country that you wish to use to reduce your tax liability in India, in the UAE, sorry. You should have those evidences with you. Important thing here is the tax return form is also asking for the auditor details, name of the auditor, and also the nature of opinion given by the auditor. So you have to select whether an auditor has given a qualified opinion, unqualified opinion, disclaimer of opinion, etc., and the name of the auditor as well. The auditor has to be a licensed auditor in the UAE, and not any other person can audit your accounts. And audit is mandatory for all the qualifying free zone persons and the companies having a revenue of more than 50 million dirhams. So apart from these two, audit is not mandatory as per the corporate tax law. Of course, as per some free zone authorities, the relevant free zone authorities, they do ask for audited financial statements, and that is how you have to get your accounts audited regardless of you being a qualifying free zone person or having a revenue of more than 50 million dirhams. That's a free zone requirement. So as per corporate tax law, these thresholds are there. Another thing is interest capping schedule. So interest, these are basically thin capitalization provisions under the law wherein an excess interest has to be disallowed while computing the taxable income in excess of 30% of EBITDA. And there are two types of interest capping provisions in the law. One is a general interest limitation and another one is specific interest limitation. Okay, so in general interest limitation, 30% of EBITDA limit applies, and it will only apply if your net interest expenditure exceeds 12 million dirhams, otherwise not. For a specific interest limitation rule, only related to the loans which have been given by the related parties, group companies to each other, let's say for acquiring any equity interest in another company, or let's say for any dividend. So that kind of deduction is not allowed at all under Article 31. There's an important catch to this Article 31 specific interest limitation rules, wherein if if the company, if a taxable person is able to prove that this loan has not been taken to get the corporate tax advantage, then the deduction can be claimed of that interest, otherwise not. Elections that you wish to opt, you should have those handy in a working paper before you proceed to file the return. I'll cover these elections in detail in the coming slides. Next slide. Okay, so corporate tax return, where to file it? It's on Emara Tax portal. So how does it look? So this is a glimpse of the Emara Tax portal, wherein a corporate tax return with a tax period of Jan to December has to be filed by 30th September 2025. So here, if you can see highlighted in green, the return due date is shown 30th September. On the right hand side, it's a status and action, the last two columns. Status is open because the return is yet to be filed, and action is filed. So you have to click on the file and then you have to proceed to file the tax return accordingly. Next slide. So what all are the parts of the tax return that you have to, keep in mind, that you have to deal with, you have to fill in those, sections, particular sections. So there are 8 parts in the entire tax return. Starts with the taxpayer details, then elections that you have to make, accounting schedules that you have to, insert and fill in, accounting adjustments and exempt income, reliefs under the law, some other adjustments, miscellaneous adjustments, arriving at a final tax liability figure, utilizing your foreign tax credits, if any, and then reviewing the entire form and declare that whatever information you have submitted is true to the best of your knowledge, and submit the return. And after submitting the return, the status in the previous slide, which was shown as open, it will show as submitted. It's under review, and then the action would be closed because action would be shown as in review after you submit the return. Next slide, please, Anuj. Part 1, which is the taxpayer details. It is mostly an auto-populated section. It will take most of the information that you have submitted during the corporate tax registration of of your company. It will reflect the name of the entity, tax registration number, tax period. So all of this information you have already given when you were registering for corporate tax. So this gets auto-populated from there, and you have to make sure that it's all correct. Otherwise, it's a wrong return form that you will end up filing at the end of the day, and the return would not be accurate. So this particular auto-populated section is very important. If you see there is any inconsistency, for example, name is right, but the legal entity type is different. You are a resident, but it is showing as non-resident for some reason. So you have to amend this taxpayer section then and there, and do not proceed further, because until this gets rectified from the authorities, you cannot proceed further in order to file an accurate tax return. So you have to amend the details, and you'll get the option to amend the details then and there. You have to file the amendment, and then once the amendment is approved, then you have to come back again in the safe draft and then file the remaining portion of the tax return. So you have to declare your total turnover. For natural person, please ensure that you do not have to include your salary or your personal investment income in your total turnover. Only business income that you have to consider in that 1 million dirhams. Accounting method you have to choose. Portal gives you option to choose the accounting method. It's an accrual accounting method by default. Cash accounting is allowed for very small companies for a revenue less than 3 million dirhams. By default, the tax portal follows accrual basis, and you can change if you follow it if you do not fall under the criteria of more than 3 million dirhams. You have to list all the business activities which are mentioned on your trade license. So you have to see what all business activities are there in your corporate tax registration certificate, in your trade license as well. So if any of the business activity is not added, you have to add that business activity code, and then proceed forward. Disclose other things such as whether you are a part of any M&E group. So in many cases, it has been seen that an entity is having less than 3 million dirhams of revenue in UAE, but overall the global revenues of the group is more than 3.15 billion dirhams. So you have to select whether you are part of that multinational entity group for which the global revenues is more than 3.15 billion dirhams. If you're claiming any exemption, so there are exemptions in the law for government entities. So if you claim any exemptions, you can of course, select that. At the end, update, you have to make sure that the entire taxpayer details part one of the return is entirely updated, and any of the information given there is not inconsistent to your business. Next slide, please, Anuj. Coming to an important part now is elections. So there are six types of elections rather in the law, which you mean most of these elections you can only do in your first tax period and is irrevocable. So it starts from realization basis to transitional adjustments, small business relief, group transfers relief, business restructuring relief, and foreign permanent establishment exemptions. Important point here is that once you elect it in the return, there is no separate federal tax authority approval which is needed. You just elect it and it's done. There is no separate approval required. Anuj, next slide, please. Elections in detail we'll discuss here. First election and the basic election is a free zone company can elect to be taxed at a normal 9% tax rate. So by opting for this tax rate, the free zone, the qualifying free zone person's status is forfeited, is taken away with for 5 tax periods and will be subject to general 9% tax. So be very careful whenever dealing with a free zone company. So free zone company can elect to be taxed at 9%, but if you once elect it, then the benefit of the 0% in case, if it's there, it will go away for the next five. It will go away for 5 tax periods, including the current tax period. Another election is to use the realization basis. So this realization basis election can only be used by businesses who are preparing their financial statements on an accrual basis. So what this election means is that you can select all the assets and liabilities which are subject to fair value or impairment, or only those assets and liabilities which are categorized as capital under the IFRS to be taxed on realizable basis. So for instance, there is an unrealized foreign exchange gains or loss in your financial statements. You can only take those into you can only take those into account in term while computing tax if you do not elect to be taxed on realizable basis. So if you elect to be taxed on realizable basis, any unrealized gains and losses have to be excluded. Foreign PE exemption, simply speaking, an overseas branch of a UAE company is a foreign permanent establishment. A UAE company can choose to exclude the income from foreign PE. Hello, I'm so sorry. Byash, Anuj, can you hear me?
Yes, Ishu, you're audible.
Yeah, okay. Great. So I was telling you about foreign Ps. So this exemption, once it is taken by a UAE company, they have the option to exclude their income and losses from that respective foreign PE. Important condition is here that you can only choose to apply to only those foreign PEs who are subject to corporate tax of more than 9% in their respective foreign jurisdiction. Next slide, Anuj. Transitional rules election, which is on immovable property and the gains on recognized on financial assets and financial liabilities. To put it in simple words, if you own any immovable property before the start of the tax period and that immovable property is recorded at historical cost in your financial statements, you can adjust that cost to a current market value at the start of the tax period, and you can kind of exclude the gains which accrue to the pre-corporate tax period. So in a way, it is a benefit for you. So for example, a company brought some property in 2017. Corporate tax came in 2023 for them. So this 2017 to 2023, whatever gains will accrue at the time of selling of this immovable property, let's say in 27 or 28, can be excluded because there was no corporate tax in the UAE. That's what it simply means. And the law gives you two methods to kind of arrive at those amounts. One is a time apportionment method, and another one is a valuation method. And this valuation can only be done by registered valuers of DLD. It's the name of those valuers are there on their website. You can please visit that website, and if you have an immovable property on your balance sheet, please get it valued so that you can take the benefit of this election while filing your tax return. This election is irrevocable, and if you once you have elected this, it cannot be revoked back. Similar election is for financial assets and liabilities. So any financial asset and liability that you owned before the 1st Jan 2024, assuming it is your first tax period, and they're recorded at their historical cost, you have the option to adjust your taxable income for gains and losses related to these assets and liabilities as well. And again, this election is also irrevocable, and you have to elect all of this at the time of your first tax return. If you don't elect for this in this first tax return of September 30, you cannot choose to take the benefit of transitional rules in the coming years as well. Anuj, next slide, please. Small business relief. So any UAE resident company having a revenue equal to or below 83 million in a relevant tax period can choose not to have any taxable income, pay zero tax effectively, and not required to calculate any taxable income and complete a full tax return as well. Please be mindful of these things in whenever you're dealing with a small business relief case, is that this does not apply to a qualifying free zone person. This does not apply to a non-resident entity. This does not apply to any of the company who is a part of an M&E group with a consolidated global revenues of 3.15 billion dirhams. Another important relief is a group transfer relief and a business restructuring relief. So group transfer relief, simply speaking, if one company gives an asset to the other company, this would create a profit or loss situation for the company who is giving an asset to the other company and has to be taxed accordingly, right? But if they make a group transfer election in a tax return, then this transaction becomes tax neutral. Then there is no gain or no loss in such situation, and the tax is only triggered later if this asset which is transferred is sold after a lock-in period of, let's say, 2 years. So it's a clawback provision in the law. So this election, once you have elected this, once you have selected once you have gone for this election, it applies by default to all the subsequent transfers. It's a very important point. If you have taken a group transfer relief election, it will apply automatically to all your subsequent transfer of assets and liabilities which you have held on capital account. Coming to the business restructuring relief, in this applies in cases of merger and demerger. So a transferor at the time of, let's say, selling its business or assets can actually elect for the tax relief in its tax return, where the assets and liabilities which are transferred are being treated as being transferred at their net book value, which ensures that there is no loss, no profit situation. So it's a kind of a business restructuring relief election that you choose, that at the time of selling of your business sale or an asset sale, you choose not to be taxed because the assets and liabilities are transferred at net book values. Anuj, next slide, please. Qualifying free zone person. An important part of this webinar is a qualifying free zone person, because I I get into a discussion with a lot of free zone companies, of late, wherein they wish to take 0% tax rate, but they haven't, been subject to a proper impact assessment so far. In the belief that they're under 0% bracket, but this is not how it is. So for a qualifying free zone person, there are lots of things that you have to answer while preparing the tax return form. Basic 6 conditions are there that you should keep and hold of whenever there is a qualifying free zone person, situation. That they should not elect to be taxed at 9%. They should derive only qualifying income. Qualifying income is already listed in a ministerial decision. They should have adequate substance in the free zone, which means they should have adequate number of employees, full-time employees sitting in the free zone working for them. They should comply with all the transfer pricing provisions. So all the related party transactions that a free zone company is doing with each other, they have to be at arm's length mandatorily, no matter what, if they want to claim a qualifying free zone person status. They should maintain audited financial statements regardless of the amount of their revenue. They should meet de minimis requirements. So de minimis requirements are basically related to your non-qualifying income. So there is a qualifying income, which is 0% tax, and then there comes non-qualifying income. Let's say if a company has done fixed deposits in the bank and they are getting some interest on those fixed deposits. So that's not their qualifying income, because let's say if they are into distribution activities. Okay, so we have to see whether this non-qualifying income is below this de minimis threshold or not. And this de minimis threshold is 5% of the total revenue of the free zone company, or 5 million dirhams, whichever is lower. And if this de minimis threshold is breached, then the entire income gets subject to 9%. Anuj, please go on to the next slide. Yes. So information required for corporate tax return. Specifically, you have to put in the details of revenue, qualifying income, non-qualifying income, and then the de minimis details gets auto-populated in the return. You have to mention the average number of employees in the free zone and others at the beginning and the end of the tax period as well. This is to meet the substance requirements. If in case you have outsourced some work to another free zone company, you have to provide the details of outsourcing as well, name of that party, TRN of that party, location of that party, and such. You have to mention the list of qualifying activities that you have undertaken, operating and capital expenditure that you have incurred in deriving that qualifying income. This is very important. In deriving that qualifying income, you have to mention that operating and capital expenditure. Important observation while filing the tax return uh, at our end was a disclosure of Emirates wise EBITDA and salaries and wages figures. So this is a qualifying free zone person, something that a qualifying free zone person has to mention therein, which is their Emirates wise EBITDA for Dubai, Abu Dhabi, Ras Al Khaimah, Ajman, and other Emirates, and their salaries and wages that they have paid. Last tick box that a qualifying free zone person has to do is a confirmation on Article 18 conditions. They are nothing but those six conditions which we have discussed in the previous slide. Transfer pricing, audit, qualifying activity, de minimis thresholds. They have to be in a listed free zone. That's another requirement. And they should only and they should not elect to be taxed at 9%. Anuj, next slide, please. This is a detailed summary of what we have discussed previously, that what all you have to mention in the return, what all you have to put in the return whenever you're dealing with a qualifying free zone person. I want to actually place more emphasis here on the free zone companies having an intellectual property income, because most of the tech companies I deal with, they have their intellectual properties housed in either Dubai or Abu Dhabi in free zone companies, and they get royalty income out of it. So there is a proper intellectual property schedule in the return, that if you have any IP income, you have to describe the IP. Which IP is it? For example, is it a patent? Is it a patent or it's a software? And you have to enter the total intellectual property income earned over there. You have to also mention the overall expenditure that you have incurred, which includes your R&D and development costs, outsource cost, and you have to mention the qualifying expenditure in case of the intellectual property as well. Other things apart from the intellectual property we have already covered, that you have to declare the type of each income earned, and you need to identify whether it's from a qualifying activity or whether it's not from a non-qualifying activity, and the de minimis figures are calculated automatically by the return. In case of substance details, you have to report average number of full-time employees, total operating expenditure, and capex. You have to also, like we already mentioned you, that Emirates wise breakdown of EBITDA has to be given as well. This reporting is at the start. So whenever you're starting your tax return as a qualifying free zone person, this reporting is at the start, and it's mandatory to claim the 0% tax rate for your entity. Anuj, next slide, please. Coming to the other part, which is an accounting schedule, it is nothing but it's kind of your profit and loss account, statement of income, other comprehensive income, and then your balance sheet figures that you have to put in over there. There is an accrual basis of accounting, which is selected by default, treated as a standard method. You have to put in all your details over there: net profit, P&L amounts, balance sheet figures, OCI amounts, all of those figures. Important point here is audit confirmation. So if you are a qualifying free zone person, audit is mandatory for you. If you are a company having more than 50 million dirhams of revenue, audit is mandatory for you. You have to, like I've already mentioned, give the name of your auditor and specify the nature of opinion given by the auditor. Next slide, please, Anuj. Key points to be mindful of whenever you're actually filling in your accounting schedule. You have to maintain an Excel sheet, you have to maintain some workings beforehand, that it clearly reconciles your accounting income to your taxable income. And this will be the ask for auditors as well, because this is what is happening in with most of our clients as well. You have to ensure accuracy, that whatever accounting schedule is, whatever accounting schedule is filled with amounts, whatever amounts with, you have to match those amounts to your financial statements. There should be no inconsistency. And if you are claiming a small business relief, then of course you may simplify this section and there is no need to calculate any taxable income. Anuj, next slide please. Other matters, so simple matters from the accounting perspective, that you should just adhere to the matching concept. Expenses of one entity should not be booked in another entity, and similarly income. Adequate provisions should be there, no ad hoc provisions. Personal expenditure and income, if any, it should not be there in the books because it is disallowed. You will not get a tax deduction for that. Adequate provisioning for even impairment of inventory should be done. An important point, the financial statements should be prepared in accordance with IFRS. So IFRS is followed in the UAE. And if you are a small company, IFRS for SMEs is followed. Anuj, next slide, please. Accounting adjustments is part 4. It will, like, it's adjustments. So like the name itself suggests, it is adjustment to your accounting income. So if your profit and loss account has a profit of, let's say, 1 million dirhams, then you have to adjust that profit in order to calculate your taxable income, because accounting profit is not equal to taxable income. You have to do some adjustments which are there under the tax laws. Key adjustments are basically your unrealized gains and losses. You have to include them unless you opt for realization basis. And this applies to OCI income as well. So OCI is something which is not rooted to P&L directly, but you have to take into consideration that as well if you do not elect to be taxed on realizable basis. Exempt incomes, if any, recorded in the profit and loss account, they have to be subtracted, like dividends. So dividend from domestic companies in the UAE are exempt without any conditions, no questions asked. Dividends from overseas companies are exempt, subject to the participation exemption conditions under the law. Equity method of accounting. You must have seen share of profits and associates from share of profits and losses from associates and joint ventures in the financial statements. Please be very clear in this point, that if they are recognized under the equity method of accounting, then you have to take them at cost, which means you only have to take the dividends, if any, coming from those joint ventures and associates, and not the share of profits. So these share of profits and losses have to be excluded from the taxable income whenever you're dealing with associates and JVs in the financial statements of your group company. Which incomes which are not recognized in P&L, these are OCI incomes. Anuj, next slide, please. Part 5, which is relief. So what all reliefs are there under the law? So mostly there are 4 types of reliefs in the law, which is a transfer within a qualifying group, business restructuring relief. We have already touched on this aspect. It is mostly in case of mergers, spin-offs, demergers, restructuring. So election must be made for each business restructuring transaction. In a transfer within a qualifying group, elections, once it is done, it applies to all transfers subsequently. There is no need to apply a separate election for that. Tax loss relief. So tax loss can be carried forward indefinitely in the UAE. However, it can only be used to offset the next year's income to the extent of 75% of the same only. So next year income can only be offset to the tune of 70, only 75% of the next year's income can be offset with the losses of the previous year, of the previous tax period. So first tax period is 1st Jan 24 to December 24. So whatever losses are there, whatever taxable loss is there as at December 24, you can only offset with a 75% of the next year's income if in case it will be an income scenario next year. Losses can also be transferred in a group if 75% common ownership is maintained. So that's another part of a loss transfer. Foreign PE exemption, we have already covered under the elections section, that this is also a kind of a relief given under the law, that you can choose, a UAE resident company can choose to exclude the income and losses from the foreign PE. Anuj, next slide, please. Other adjustments. So other adjustments are basically non-deductible expenses under the law. There are some items which are categorically disallowed, that you have to add them back to your accounting profit to arrive at a taxable income. Entertainment expenses, it is 50% disallowed. However, staff expenses are fully deductible. So there is a distinction between entertainment expenses incurred on customers, on shareholders, however, not on staff. So on staff, 100% is deductible. On others, it is 50% disallowed. Blanket. Bribes, fines, penalties, they're all disallowed. Dividends, personal expenses, like I told you, it's disallowed. Corporate tax, donations, unless you pay to the qualifying public benefit entities. So whenever you're actually scrutinizing the trial balance, you have to make sure that the donation ledger is looked at properly, that these donations should only be to qualifying public benefit entities and not anywhere, not to anybody else. If they have been given to anybody else, the deduction from the tax point of view would not be allowed. Interest deduction adjustments, like it has a general interest limitation and a specific interest limitation. Related party and connected person adjustments, these are transfer pricing adjustments that you have to do here. And this includes intra-group service charges, management fees, royalties, etc. Anush, next slide, please. Important point is part 7, tax liability and tax credits. So tax credit is about foreign tax credits here, that if a UAE company has been subject to tax in some foreign country on some income, they can take a credit in the UAE for that. However, that foreign tax credit should not exceed the UAE tax payable on that income. This is a crucial point here, and it should be backed by a foreign tax payment proof. So there should be a proof of paying tax outside UAE, then only a foreign tax credit can be claimed. Tax payment is on the Imara tax portal only. It is under my payments. So if you see the screenshot in front of you, it is total tax payments due. It's zero at the moment because the return is not filed, return is not prepared in this example. So you have to kind of, tax payment will come, the amount will start reflecting here under my payments tab on the Imara tax portal, and you have to then pay accordingly. You have two ways to pay it. One through global IBAN, and another one is through you can pay by card. Anuj, please next slide. Corporate tax whole template, how to compute the tax liability. So whatever we have discussed in the previous slides, this all is summarized here in one slide. It starts from the accounting profit and loss. Then you have to adjust for unrealized gains and losses only subject to election. Then you have to subtract exempt incomes like dividends, participation exemption incomes, capital gains, PE exemption. Then take some reliefs like group transfers, business restructuring relief, and non-deductible expenses. I'm so sorry. Transactions with non-deductible expenses, which is expenses incurred in relation to an exempt income. So like dividend is exempt. So whatever expenses you have incurred to earn that income will be disallowed as well. So these interest capping limitations, entertainment expenses, penalties, fines, input VAT recoverable, donations paid to non-qualifying public benefit entities all have to be disallowed. And then transactions with related parties and connected person, TP adjustments you have to do. Coming to this, again, tax losses relief, which is, of course, carry forward losses, which can be carried forward indefinitely. For the first tax period, there will be no carry forward loss, so it will be nil. For the subsequent tax periods, there will be amount if in case there's a loss in this first tax period. Then the final taxable income after all of these adjustments, and you have to pay 9% over and above 375,000 dirhams. So this is going to be your tax liability, and you can also subtract your foreign tax credits, if any. Anuj, next slide, please. These are some FAQs which we have taken from Ministry of Finance website. Who can submit the tax return? It can be submitted by any taxable person, any tax agent or their legal representative. Due date is 9 months. And can you amend your tax return once it is filed? Yes, you can amend by way of voluntary disclosure. You have a time period of 5 years to do that. So can you save the corporate tax return format and then, as a draft, and then you can come back again and start working on it? Yes, you can save it as draft and then you can start working on it again. Anuj, next slide, please. Yes. So how many times you can amend your corporate tax return once it is filed? There is no time limit as such. You have a period of 5 years from the end of the relevant tax period to submit a voluntary disclosure to amend the tax return. And what is the due date to pay the tax liability? So it is same. It is 9 months from the end of the tax period. And payment can only be made via Emara tax payment gateways and not through anywhere else. Anuj, next slide, please. Yes. So how can you check whether FTA has actually emailed you something or has only sent you some, information requirement? So you have to check your Imara tax account on a regular basis under My Correspondences section under the corporate tax tab, under the corporate tax tab to check for any updates from the Federal Tax Authority. And what should you do if your taxpayer profile contains any incorrect information? You have to file an amendment application before filing the tax return. How is the de minimis threshold calculated? It is auto-populated. You just have to mention your qualifying income and non-qualifying income. De minimis income gets automatically calculated based on the figures you have provided. Anush, next slide, please. Yes, this is about it. Thank you so very much for patiently listening to me for over 1.5 hours. I want to thank you all, and yes, would be happy to take questions.
Sir, it seems there are few questions from the participants in the chat. Shall we take a moment
Mhm.
to address them?
Yes, please.
So the first one is, do we require a valuation certificate to ascertain the value of financial assets and liabilities?
Okay. Yes. So for financial assets and liabilities, no. Only for immovable property you need it.
The second question is, do we need to have financials mandatory in AED? I think it should note as presentation currency can be
So
anyone.
see, you have to prepare your taxable income tax computation in AED. You have to convert those figures into AED mandatorily. However, there are few companies like there in companies in DIFC who have to prepare their financials in US dollars. They're mandatorily required to prepare financials in US dollars. But for tax purposes, you have to convert all of that in AED and then pay tax. And
So the
there is a proper mechanism to convert it. You can convert it in order of spot rate and then average rates. It's a proper mechanism to convert those foreign currency figures in AED given under the law.
the next question is, what is the taxability of FD interest income and forex gains for a qualifying free zone person? Will forex gain be considered as an ancillary income?
It's very fact specific. It all depends on what kind of business activity they are into. So prima facie, it will not be a qualifying income, both FD interest and the forex gain.
Moving to the next one, whether unrealized gains recorded in financial statements and transfer pricing adjustments directly made in the CT return are required to be considered as revenue in de minimis and small business relief thresholds.
I'm sorry, I didn't get your question. Can you please repeat?
Whether unrealized gains recorded in financial statements and transfer pricing adjustments directly made in the corporate tax return are required to be considered as revenue in de minimis and small business relief thresholds.
See, if you do not elect to be taxed on realizable basis, then of course you have to include, but that de minimis threshold is automatically calculated. So I'm still not sure about like what the other person wants to ask. But yes, you can, yeah, you can actually we can take this after the session, because if you do not elect to be taxed, then everything gets included and the de minimis gets automatically populated. You have to mention all the revenue figures in the return itself.
Moving to the next one.
Yeah.
Can we
Yes.
s- can we select more than one e- election in one return if I am maintaining books on approval basis and have property immovable in balance sheet financials?
Sorry, can you?
Can we select more than one election in one return if I am maintaining books on accrual basis and have property immovable in balance sheet financials?
Yeah, you have elections to make. Yes, you can do elections for realization reliable basis separately, and then for transitional rules separately. Yes, you can do that.
Okay. And then the next question is under related party schedule, what has to be reported in assets and liabilities? Does it only cover actual transfer of asset liabilities or it also covers the principal movement of loans?
It covers the principal movement of loans as well. That's a very good question. Yes, it covers all the related party transactions, regardless of their nature.
Moving to the next, in case I do not elect for realization basis and there is OCI gain pertaining to change in fair value of equity instruments, can
Mhm.
participation exemption be claimed on that through it is unrealized?
See, OCI gains are not excluded from the tax ambit. So if you do not elect to be taxed on realizable basis, again, it depends on the election. So OCI, unrealized gains in the OCI, which will not subsequently be recognized in profit and loss account. So you have to exclude them if you elect to be taxed on realizable basis. If not, then of course, you have to pay tax on them as well.
Sir, in response to the previous answer of related party schedule, one more question is what about funding arrangements? This is also applicable, right?
It could be, yes, it could be treated as a loan from the transfer pricing point of view, yes. So all the working capital support and the funding arrangements that group companies give to each other, they all get characterized as loans.
Now, moving to the last question. If transactions billed to free zone person and shipped to non-free zone person, then 0% can be applicable on that income.
If the transaction is billed to free
If
zone,
the Yes, if the transactions are
and
billed to
sorry,
free
if
zone person and shipped to non-free zone persons, then the 0% tax can be applicable on that income.
no, so basically it's a free zone to free zone. So that is also covered in the free zone guide also. So yes, it will not be qualifying income in that case.
Uh, Another
Okay,
question
I think
in
yeah.
one last question. If we include principal movements also, then what amount to be reported in arm's length in income? Because principal transfers has no arm's length price. It is the interest on such principal leads to arm's length income.
Yes, yes. So basically, you have to calculate, you have to justify somewhere that why the interest is not warranted on those funding arrangements. You have to keep a proper justification to that. Otherwise, you have to do a proper benchmarking analysis and then arrive at a certain range. Of course, it all depends on the credit rating and everything. So it's all fact specific. Okay, Anuj?
Sir, one more question. Is UAE counting tax jobs are outsourced to India?
Is UAE accounting tax jobs outsourced to India? I can't say. I can't say about it because it's not a tax question. I'm really sorry I didn't get what you want to ask. So no, I can't say about it whether they are getting outsourced or not. I'm really sorry about it. No idea.
That's the end of the question, sir. Thank you.
Oh, thank you. Thank you, everyone. And if in case there are more questions, if in case you get some thoughts after thoughts after this webinar, and you still want to ask me something, so please feel free to reach out to me on the email ID provided, and we will certainly get back to you with a reply. And once again, thanks a lot for your time.
Thank you, everyone. Have a nice day. Bye bye.
Bye.